This program proudly brought to you by IPO Wealth for the sophisticated investor.
Hello and welcome to Money Talks. With the persistence of this stock market slide, which has investors asking, is this a correction or the prelude to a crash? Along came US economic forecasts for 2019 that were downbeat compared to previous expectations. So we asked the question, have we been counting our US and therefore our Australian economic chickens and market chickens before they're hatched? To look at this important question for anyone investing in stocks, we have Pengana's Stephen Glass and Simon Shields of Monash Investments. And in the context of this troubled stock market with numerous question marks hanging over it, Julia Lee will give us her hot stock of the week from the utilities sector. Okay, well, Stephen Glass is Head of Research and Portfolio Manager at Pengana International Equities. And if anyone will have a view on the US economy and stocks, it would be him. Welcome, Stephen.
Hi, how are you, Peter?
My pleasure, my pleasure. Now, we should actually just get a few things straight first of all. So you manage Pengana's international equities, is that right?
I co-manage it with my business partner, Jordan Svetanovsky, who is a CIO, and then I'm Deputy Portfolio Manager. Okay, right. And last year at the Sohn Hearts and Minds Conference, you were reputedly the best stock picker, coming up with something that returned 40% over the year? Yes, when measured from October to October, taken from one of News Corp's publications.
The Australian, who would question the Australian? Not me.
Yeah, so I actually, a stock I selected was actually the best performing stock from October to October. It was IAC, which is an internet conglomerate, and we bought it for we bought it for a number of reasons. We believed it was cheap, we believed it was well managed, and it had some amazing growth options owing to its business called Home Advisor.
Okay. Right, so you would have noticed, as I noticed last week, there was a number of famous institutions, Goldman Sachs was one case in point, which downgraded the outlook for the US economy, and others didn't really pile in. I think it's still a minority view that the US economy would be growing, I think, of the order of average around 2% next year. And that kind of didn't help the stock market. It seems to be worried about a whole lot of other things, including Trump and trade wars and whatever. What's your view on the US economy next year? And is it important to your stock picking?
The economy is always important because it creates the backdrop. But what really matters is the quality of the businesses and the valuations, because we're not looking to buy something based on what's going to happen next year. We look to buy to hold for the long term. So yes, it matters, but no, it's not the driving force. What we think is really driving the share market at the moment are really valuations. We've had a bull market for something like 10 years now. The stock market has, there's lots of signs of exuberance. And so earlier this year, actually in the first quarter, we took a lot of risk off the table. We did something that I think was pretty gutsy and was counter to what everyone else was doing. And we sold our high growth tech positions.
So your FANG stocks and things like that?
FANG stocks, but also other ones like IAC, GoDaddy. There were a number of other stocks that were not FANG, but were in that basket. And we just saw these signs of exuberance and we decided it's time to take money off the table. Now, in the share market, it's always dangerous trying to predict where the market's going. Very few people get it right consistently. So you want to stay invested, but you can dial up or dial down the amount of risk you have. So what we did is we sold down those riskier, fully valued stocks. We bought something called put options, which provides portfolio insurance, and we pivoted the portfolio towards safer, more secure companies. And for a period of time...
And these were primarily in the US, or you go right around the world?
Well, we look everywhere and anywhere. We have about 35% of our portfolio in the US, but we actually have quite a lot in Europe. As far as I know, and you can't quote me on this, we probably have the most European exposure of any international fund in Australia. And the reason we did that is because our concern is valuations, and we're finding world-class companies at good valuations in Europe, but interestingly also in Asia. Asia has been a bit of a bloodbath of late. And we have quite a large position, for example, in a company called Bharti Infratel, which is a cellular tower business based in India. And that's a very interesting business because it's got no debt, It's got a very attractive valuation, and it's now benefiting from the decline in the oil price, which is something people call the oil dividend for countries like India, which have a big capital account deficit, or sorry, current account deficit. So we think we move to where the valuations are. We're looking for high quality businesses. We're not trying to guess what's going to happen next year. We're looking out for the long term. And if you can find a high quality business at the right valuation, we think it's always good to act.
So Stephen, if the forecasts last week were that the US was going to go into recession and everyone said the same thing, how would you react as an investor? Would some stocks you'd hold because you think they were recession proof, but others that you think are exposed to a recession you would like you're holding?
Well, I think the starting point would be, do we believe the US is going to go into the recession or not?
Question.
So if we believe the US was going to go into the recession, we have actually gone into our portfolio and we do measure which other positions that are going to be hit hard by that type of scenario. And at present, approximately 30 to 40% of our portfolio is directly exposed to the US economy, which isn't actually there's lots that are exposed, but have a high beta, high correlation to the economy.
Yep.
And those stocks would get hit. Now, that sounds like a lot, but it's not actually a lot, because what happens if the economy keeps on chugging along? There's a lot of reasons it could.
And is that your view, that you suspect it's more likely to chug along than have a devastating drop into 2019?
Look, we don't try to guess where the economy is going, but it's a fair question, and we are paid to have a view. We don't think the US economy is necessarily going to have a devastating drop. I mean, that is a big call. But can it slow down? Absolutely. But are there levers they can pull to keep it chugging along? Sure. So we've got infrastructure spend, we've got housing, which has been weak. There can be policies to encourage more investment in housing. But the thing that really concerns us about the US economy are more these bigger factors. So it's quite strange, to say the least, that during an economic expansion, the US government is actually pursuing fiscal expansionary policies, lowering tax rates, things like that. And you kind of wonder what's going to happen when things slow down. What's going to be left in the tank to help the US economy? There are a lot of mid-sized US companies with a lot of debt at the moment, so gearing has actually increased in the mid-sized part of the US economy. So there are some things that make us very concerned about the US economy. However, this is a long-term issue. It's not necessarily a next year issue. Some of our positions that could get hit include American Express. Whether we like it or not, it has a lot of economic exposure. But we think it's a fabulous business at a great price. So we're happy owners, provided you've got the right position size.
Okay, so when you try to establish your investment strategy, and you've said you take into account the economy, what about the Trump trade war play? There's no textbook or any previous US presidential experience that makes you comfortable with that. And we've got the G20 meeting coming up on the weekend. If the two presidents, President Xi Jinping and President Trump, come to some kind of agreement on what the tariff situation will be, and both are happy to walk away in a brotherly love kind of way, do you think the stock market's going to respond very positively to that?
Well, it should be a positive catalyst for the share market. Again, we're not going to invest on any singular event. We don't like binary investing, but it's something that we have to consider right now.
You could be a beneficiary.
We could be a beneficiary. So we have approximately 10% of our portfolio directly invested in Chinese stocks, so they should do very well.
Yep.
We also have a number of industrials based in Europe that should do very well from that. However, having said that, our attitude towards these kind of events is there's always some issue du jour somewhere in the world, whether it's the Italian elections, a Greek bank crisis, Brexit. There's always something somewhere, and we don't want to be focused on these myopic issues. We've got to keep our eye on the prize. We've got to have high quality businesses. We've got to have an excellent portfolio construction methodology. We have to give people what we say we're going to give them, but also you also have to have overlays. And I think the key thing I have to say there is, that could very well be a positive for the share market, but we're not going to invest based on this one-off event. But yes, it should be positive, particularly for industrials and Chinese stocks, and the Aussie dollar should be a beneficiary.
One last quick one, because they are winding me up.
Okay.
The FANG stocks have been belted up. Have they been belted up enough for you to think about buying them again?
We do own Alphabet, which is Google, and the reason we own that is the valuation makes sense to us. So it makes about $100 billion in advertising revenue, $20 billion goes to its partners, so that's $80 billion of advertising revenue. Its EBITDA margin on that would be at least 70%, so 50 to 55 billion of EBITDA, I can justify the valuation. Amazon, I find it very difficult to. Netflix, I find it difficult to. Apple, we don't think they're investing enough in innovation. So we look at specific stocks rather than the broad portfolio.
Stephen, thanks for joining us.
Thank you, Peter.
Stephen Glass from Pengana. Welcome back to Money Talks. I'm Peter Switzer. The utilities sector is considered defensive and usually outperforms when times are tough. Julia Lee from Bell Direct shines the spotlight on this defensive sector. It's unusual to see you defensive, Julia.
Well, you know, the share market was down 6% in October. We're already down about 3% in November. And as, you know, things get a little bit more difficult probably in 2019, I think it is time to start thinking about the alternatives to growth.
I always ask you this question, but what percentage of your portfolio is defensive?
40% at the moment, probably moving to 50% by January.
Yeah, well, when I first met you, you were unmarried and had no children, but now you've got, you've got two kids. You're becoming old-fashioned, 40% defensive.
For me, it's all about the macro cycle. I'm happy to be at 100% in equities when inflation is rising and growth is rising. But as, you know, the question over whether growth is now slowing down, so we've still got growth, but it's slower growth, and inflation's still rising, I think that just means it's a little bit more difficult for the growth areas of the market.
Aren't you afraid you'll miss one more big leg up before it becomes really sensible to be defensive? Because you're being very cautious being defensive. Now, you could end up being right, but
I still have 50% of my assets.
Okay, right, yeah, okay. Good explanation. Okay, so we are concentrating on utilities. Why?
I guess looking at the utilities space, and it's often thought of as a shelter from the storm, and that's because as a sector it has a very nice distribution yield of 5.5% for the sector.
Lovely.
But that's because it has stable cash flows as well. Now this is usually a regulated industry, which means they can't just put their prices up however much they want to. But because of those stable cash flows, they tend to borrow a lot of money, and that means there's a little bit of extra risk related to that as well. But
particularly if they roll off their debt to higher interest rate environments.
So stable cash flows, nice distribution yield. Usually investors, when there is volatility, are willing to pay a little bit extra for those stable cash flows near term.
Okay, let's talk about the stocks you like in this sector.
Well, you know, this one has been one that I haven't liked, but, you know, I truly believe, Peter, that even the worst companies sometimes are the outperformers in your portfolio, and sometimes it just comes down to price. And I think the market has been a little bit too harsh on AGL Energy. So at these prices, you know, the risk-reward profile for it looks attractive. So AGL Energy has been marked down by the market, as you can see from the share price graph there, because of the regulatory risk and, of course, the government talking about some of the changes that they want to make in terms of putting a floor or a ceiling on electricity prices and some of the other changes in terms of the market. But given that we have seen the shares down 22%, I think the market has overreacted.
Yeah, that's a good point. 22
I'd be happy to buy here, and I'd expect you know, a move close to that $22 mark.
What's the yield like on that current share price?
About 5.5%, which is a lot more than you'd be getting at the bank at the moment. But of course, the other thing is that this is thought of as a bond proxy because of the large amount of debt. It means that as interest rates go up globally, usually this sector comes under pressure, and completely the opposite. As interest rates come down, you usually see this sector thriving. But look, the other thing to think about, Pete, is disruption. I can't really think of many sectors of the market that haven't been touched by technological disruption. And I guess energy's been a slow mover in this area, but we're now talking about things like battery storage, energy efficient appliances, energy management devices for your household. So I think they're the type of things that we're going to be thinking about over the next 5 years.
What's AGL's exposure like to renewables?
Well, it's getting much bigger. It's much better than some of the other utility companies out there. So it is ahead of the curve, which is nice to see for a traditional utilities and energy type of company. But But the utility sector is extremely small. There's only 5 stocks in it, and I guess the one that has the most exposure to renewables is Infigen Energy, which has the wind farms and the alternative sources of energy. But looking at this space, you know, I think it is time to look at diversifying cash flows and revenue streams in your portfolio through some of these more defensive, stable type of cash flows.
What else you like? You don't always just come with one. You at least 2.
Well, the other one that looks quite interesting is Spark Infrastructure in this space, SKI. But look, that would be number 2 for me, and I do think that AGL Energy is due for a bouncing. Of course, we are watching with what will happen with the political situation, given the landslide that we saw over in Victoria. And of course, Labor has its own ideas on what it wants to do in the area of energy, especially renewables, and it might be a little bit more aggressive in adding a bit more regulatory risk to this sector.
Okay, you mentioned Spark, and a lot of people wouldn't know much about it. Just give us a little bit of a history of the company, because this is a company a lot of people like at various stages of the cycle. If you're jumping on board, it's probably the right time to jump on board.
Well, the thing with great companies is sometimes the price isn't quite right, and with the utility sector, because of APA and the bid by SKI, which was knocked back on foreign interest grounds, we have seen some of the stocks in that sector still rising up quite nicely. And if we can bring up, we probably can't bring up SKI's share price. It's performed quite nicely. So look at these levels. It's reaching the peaks that it has for the year, which is a nice place to be for investors. But at those levels, I think the valuation is relatively high, whereas AGL Energy, I think investors have been too high.
That's the big thumbs up one for tonight. Julia, thanks for joining us.
Thanks, Pete.
That's Julia Lee from Bell Direct. Now, coming up after the break, we have a hedge fund manager who really is out there looking to expose himself to the market. He had a lot of cash not long ago, but now he hasn't got much cash at all. Welcome back to Money Talks. Well, hedge fund manager Simon Shields is the founder of Monash Investors, and he told me he was very long cash until recently, but now only holds 5%. So this must be saying something about his outlook for stocks. Let's find out if he thinks we've been counting our economic and market chickens before they were hatched. Mate, thanks for coming on the show.
Hi there, Peter. Well, there seems to be quite a diversity of views this evening.
Oh, without a doubt, without a doubt. That's why we do it on the show. Get diverse people with diverse points of view. But we want to be as right as possible. And when you told me that it was 40% you were holding in cash, what, 7 or 8 weeks ago?
That's right.
Before the market tipped over and,
yes,
and dropped substantially. But now you're holding 5%. To me, that's a strong indicator that you believe there's market upside as opposed to market downside.
Absolutely. I mean, you know, the market's fallen almost 10% in that period. And the question then becomes, is that enough of a correction, or are we going to see more? I mean, the definition of a crash is like 20% falling. I find it very hard to believe that we could be headed for a crash when economic growth is not too bad. You know, inflation's and interest rates are picking up a little bit, but they're only doing that in response to a strong economy. That's what interest rates are supposed to do when economies are strong.
Are you focusing now on the US economy or the Aussie economy? Because my feeling is that it's going to be the US economy that will determine what's going to happen in our stock market rather than ours. But am I wrong in doing that?
No, I think that's fair enough. Global stock markets are so synchronised with each other, and certainly the US stock market is the lead.
Yeah, and it's kind of ahead of the curve. We're still waiting to try and pass the old all-time high, which historically markets tend to do before they crash.
Look, it's really a function of the composition of our market, the industries that we've got exposed to in the market. I think, you know, obviously the US markets run very hard because earnings have done so well in their businesses that are really globally exposed businesses. They're technology-led businesses, and you know, they're modern businesses, where in Australia we've lost a lot of that, those new businesses and stuck more with the old ones like the banking sector.
Yeah. And Simon, on that subject, I wasn't planning to ask this question, but I think it's relevant. If there'd been no Hayne Royal Commission, do you suspect that even though we might have fallen because of trade war and economic growth in the US, we'd be at a lot higher level than we are today?
I wouldn't say necessarily a lot higher. I think the banks would only be somewhat higher. Certainly, Royal Commissions do put a dampener on stocks. We saw that many years ago with James Hardie. We're certainly seeing with the banks and insurance companies at the moment. And now we've got the aged care companies have it all before them as well.
Okay. Tell us, Monash Investors, what's your investment technique?
Okay, well, we're an Australian equities investor, but we focus on absolute returns rather than relative returns, and that has some pretty important implications. Every time we go and make an investment, we're trying to make money. And we're trying to deliver over the medium...
It's unusual that you should do that. Other fund managers throw it away.
Strangely. Well,
right.
You know, for years and years I worked at large funds management organisations whose goal was to beat the ASX 200 as a benchmark. Yeah. And that implied you had to look at what was in the index and you tried to get the better of companies. And in a sense, it didn't matter whether your company was going up or down, as long as you were in the better of company, then you'd beat the market. We're not trying to do that. We're actually trying to deliver, you know, investment returns year after year to our clients.
So you're shooting for alpha in many ways, aren't you?
Well, it's an absolute alpha, but yes.
Yeah, and it also means that you can go long and you can go short, where a lot of funds are long only, aren't they?
Correct. And we have many more degrees of flexibility in order to control for an absolute risk and to try and deliver an absolute return. So shorting's one of them, but there are other things as well.
Yeah, and I know when we talked some months ago, you said that you got into Afterpay around, what, 7 or something like that.
Yes.
You wanted to prove their case before you got on. You liked the US story, and then since then you supported them, but you got out at a high price.
That's right. We saw the risk in Afterpay when it was really focused just on Australia as being a regulatory risk. The moment it announced going to the United States, we went into the stock pretty hard because, you know, consumers are consumers, and it was really a company that showed a tremendous track record in increasing the retail sales of the companies that it was using as its clients. So the market responded to that. We had gotten in fairly early, and we started lightening off after already doubling our money. So by the time the stock started to come well and truly back, we were mostly out of the stock already.
Would you go back into that stock again at the right price?
Absolutely. So we went back into the stock around the $11, $12 mark, and it's sitting more or less around that price again.
So that
today.
price, you still think it's a worthwhile company?
It's got a lot of upside, yeah.
Okay, what company do you like right now?
Well, there's quite a few companies that we like right now.
Okay, my viewers would like that. Yeah.
Okay, so one that we think is particularly exciting that has a fairly boring business normally is EML Payments. So EML Payments is a company that's involved in transaction cards, but over in the United States, there's been some legalisation of sports betting going on. So on a state-by-state basis, companies can now come in, like Bet365 and so forth, and actually do proper live sports betting in the United States. It hasn't really begun to roll out.
It's been barred before then, has it?
It has been barred before, yeah. Now, EML Payments, if you like, is
it?
EML, yep, is the, if you like, the picks and shovels for these companies because it provides the payment systems. The banks aren't really in a position to do that for regulatory purposes, but EML Payments has got a business that allows gaming companies to supply that service. So if, you know, there's a great chance that really sports betting will explode in the United States, and these guys are going to be right there when it happens.
Okay, that's a locally, or is it?
It's an Australian-based company that is a global business. So it's got operations in Europe, in shopping centres, doing gift cards and so forth. Westfield in Australia, same sort of thing.
Yeah, okay. What else do you like?
Another company that we like is sticking with the E's is Emeco Holdings. Emeco is exposed to the resources sector and it's pulled back quite a bit over the last month or so. But again, it's a provider of picks and shovels, almost literally in this case, because it rents out that yellow gear, right, that they use, the big heavy trucks, the big diggers. It's quite an asset heavy business, but at a time in the cycle when there's an increase in utilisation, there's still an increase in the rates that the mining companies are paying when they're trying to get away from running their own capital, this company's been in recovery mode for probably about 18 months or so, and there's a lot of visibility over the next 18 months to 2 years because of the nature of their contracts, how their earnings are going to be picking up over that time. So we think, you know, again, having pulled back, it's a great time to be getting in the stock.
Okay, so I made the case that, you know, you were holding 40% cash, you're now only holding 5%, and that to me was a pointer that you got positive views on the economic outlook in Australia and all the USA and the global economy?
Look, generally, I think it's pretty tough to, if you're looking at the overall value of the market, to really get it right within about 10%. I mean, you know, where the market's going to be exactly, you know, how it should be priced. But we look at things on a stock-by-stock basis, and where you've got stocks that have pulled back by 30 to 40% in businesses that are going extremely strong, that have earnings that are really coming along very, very nicely and growing at rates far, far above the rest of the economy. I mean, that ultimately is what determines the price a stock will trade at. It's its earnings per share. If you're going to get stocks that are quickly growing their earnings per share, then you don't have to wait too long, and any weakness in the market will be more than made up.
Simon, do you buy foreign listed stocks if you think it's a buy?
Yes, we can buy foreign listed stocks, but we really are focused on the Australian market.
Okay. From the point of view of the FANG stocks, do you think that they've been bidded up far too high, but now the correction that we've seen is sufficient, or do you still think they are desperately overvalued?
Well, you've got me there, because while we can invest in overseas stocks, we don't cover every stock in the world. We're a small team, so we haven't been putting any effort into looking at those FANG stocks.
Okay. Yeah. What about the resources sector? Do you have any exposure to resources? Yeah,
again, we don't like investing in companies whose earnings are driven by a particular commodity, because we don't have a view about, generally is coal or iron ore going up or down. What we do like are situations where we can look at a company exposed to resources as a business, and if there's something interesting going on there, then we can put a value on that. And so that's, for example, we talked about Emeco Holdings, very diversified to a lot of miners. We can see that those contracts are rolling over and growing. In the past, what we've been looking at have been companies that might have been exploiting a particular deposit or resource. There's some sort of catalyst that's going to happen there, and we invest in those. But right now, we've got a very limited exposure to resources.
Mate, we're out of time. Thanks very much for joining us.
Thanks, Peter.
So Simon Shields from Monash Investors. That's all for Money Talks tonight. Next week, we see if Donald Trump and his trade war is stopping stocks from going higher. And if you want any daily updates, you have a look at switzer.com.au. And we have an income conference in Sydney on Thursday. Just go to switzer.com.au/events if you want to come along. Thanks for joining us. I'll see you tomorrow night.
This program proudly brought to you by IPO Wealth for the sophisticated investor.